All right, let's talk about a deal that, on the surface, looks like pocket change for a tech giant. But when you dig in, it actually reveals a huge, multi-billion-dollar strategy playing out right in front of us. We're going to break it all down.
So the headline is pretty simple. The global IT powerhouse HCLTech is buying another company.
And they're paying just 19 million Singapore dollars for it. Now, for a company that pulls in billions of dollars in revenue, that amount is, well, it's a rounding error. So the real question, the one we're here to answer, is why? Why this small firm? What are they really buying? Okay, first things first, let's get the basic facts of the deal straight. So, here are the brass tacks. On January 23rd, 2026, HCLTech officially announced they're buying Finergic Solutions. It's an all-cash deal for $19 million, and they expect to have it all wrapped up by the end of April. Pretty straightforward stuff. But to really get to the why of this deal, you have to understand who these two companies are. And believe me, it is a classic tale of two completely different scales. I mean, just look at this. On one side, you've got HCLTech, a global behemoth doing $14.5 billion in revenue with almost 250,000 employees in 60 countries. And on the other, Finergic Solutions, a tiny, specialized firm with about 80 consultants. This right here tells you everything. This is not about buying revenue. This is a pure capability play. So HCLTech, as we know, is a massive player. Their whole brand is built around this idea of supercharging progress for their clients, which basically means they handle the giant, complex digital projects for the world's biggest companies, especially in finance. Finergic, on the other hand, is not a sledgehammer. It's a scalpel. They're a boutique firm founded just a few years ago, and they are absolute experts in one thing: wealth management technology. And crucially, they have world-class expertise in Temenos, which is one of the biggest core banking software platforms on the planet. Their offices aren't just random dots on a map either. They are strategically placed in major financial hubs. But here's the thing. This move, it didn't just happen out of the blue. If you look back at HCLTech's history, you'll see this fits a pattern perfectly. You can see it right here. They've been doing this for years. HCLTech doesn't go on shopping sprees. They make surgical strikes. Back in 2008, they bought Axon to get SAP skills. In 2019, that huge IBM deal gave birth to their whole software division. And check this out. In 2022, they bought Confinale AG, another specialist in, you guessed it, Swiss wealth management consulting. Buying Finergic isn't a new strategy. It's the next very logical move and a long-term game. So that brings us back to the big question. Why this deal? Why this company? Right now? What's the real game being played? Well, let's look at what the company itself is saying. The chief growth officer called it transformative and said it will help them deliver advanced capabilities. Now, advanced capabilities might sound like corporate jargon, but in this case, that's the whole ballgame right there. And look, it's not just them saying it. The industry analysts over at IDC have been watching HCLTech's push into finance for a while. They point to the company's platform mindset and their focus on building deep relationships. This deal is that philosophy in action. They're buying the deep expertise needed to strengthen those key relationships. So let's just spell out the strategy here. Step 1, get even deeper expertise in the super profitable financial services world. Step 2, get the talent you need to build next-gen AI tools for that industry. Step 3, expand your global reach in a hot market called wealth tech. And step 4, maybe the most important, shift from just doing IT grunt work to leading with high-value, high-margin consulting. And that word, wealth tech, is really at the center of all of this. We're not just talking about an app to check your portfolio. This is the entire technological overhaul of the wealth management industry, using things like AI and big data to modernize how trillions of dollars are managed for clients. It's a huge growing market, and HCLTech just bought themselves a VIP ticket. Okay, now this is where it gets really interesting. This wasn't a cold call. Of Finergic's $12.6 million in revenue last year, over $5 million of it, that's about 40%, came from projects they were already doing for HCLTech. So they weren't just a target, they were a partner. HCLTech essentially ought to test drive the car before they bought it. This deal is about taking that proven, trusted expertise and putting it on a global scale. So putting it all together, what does this actually mean going forward? What's the impact on HCLTech and the rest of the market? So here's the bottom line. This deal is a massive signal that HCLTech is serious about moving into the more profitable consulting space. It makes them a go-to partner for any bank that uses the Temenos platform, which is a lot of banks. And it puts them in the perfect spot to win business from all the financial institutions that are desperately trying to modernize their old tech. Now, is this $19 million deal going to make HCLTech stock jump overnight? No way. The real impact is strategic. It's an investment in people and skills that will help them win deals that are hundreds of times bigger down the road. And that brings us to the fun part, the speculative part. If this move is so smart for HCLTech, how could you think about the ripple effects? What's the trade? Well, think about what HCLTech just bought. They bought a team of experts whose job is to help banks rip out their old, outdated wealth management systems. So the interesting idea here isn't necessarily to buy HCLTech. The trade could be to figure out which publicly traded companies make those old legacy systems. Because as HCLTech gets better and more aggressive at winning these modernization projects, those legacy vendors are the ones who are going to lose. The idea would be to short the companies that are most vulnerable to this disruption. And as always, let's be perfectly clear, this is not financial advice.